Good evening, everyone. I'm Anita Sharma. Welcome to Market Call tonight. Our special guest is Jaime Carrasco. Good evening, everyone. I'm Anita Sharma. Welcome to Market Call tonight. Our special guest is Jaime Carrasco. He's the portfolio manager at Canaccord Genuity, taking your calls, emails, and of course tweets on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. A favorite here on Market Call tonight. Our number 1-855-326-6266. Our email address marketcall@bnnbloomberg.ca. Our Twitter handle @marketcall. Jaime, good to meet you.
Thank you for having me back, and nice to meet you.
Thank you. Where do you want to begin? There's so much going on. We just heard from Theresa May. She survived that no confidence vote. Boy, are there pressures around the world. Despite that, we saw U.S. markets close higher today.
Well, again, I keep thinking that there's a lot of complacency right now.
Right.
And I myself, along as other bond-related people that are looking at it from the liability side, guys like Gunlash, Dalio, we're saying the same thing, that the market has been driven by an expansion of debt.
Okay.
Right? So you got to look at the real economy. The economy is overloaded with debt. So now what's happening since October, when I said, as the Fed started pulling back money, they started pulling up, that leverage started coming out, right? So what we're having now since October is massive instability. So if the economy isn't as strong as people think it is, it's being driven only by debt, as everything starts to pull back, we're going to see more and more instability. And the key word that I would be worrying about is liquidity. Because it's liquidity is the problem. If you look at what happened in December, the market came down very fast. What was the high? 28,000, and we're almost 4,000 points, and it got down to 23,000, 22,000. So it was about a 10-15% decline in almost in a month.
Do you think
right?
people think the market's strong, though? We're getting headline after headline, concerns with China, concerns especially on the retail front south of the border.
This is the disconnect.
Yeah.
This is the disconnect. I was listening to one of our competitors, and their advice for the year was volatility, expect more volatility. Volatility is going to increase, but they find that earnings are justifiable, so too early to pull money out of the market. Well, I say it's time to be very cautious. I would completely disagree about that, because if earnings have been driven by debt, by buybacks, by air, as the air comes out, it's going to come off very quickly, right? And because of that, I don't think it's a time to be complacent. I think what comes next, let's talk a little bit about the 30s. Let's look at the historical parallels, because you have the bond guys.
Yeah.
More importantly, the monetary what occurred during the 30s from a debt perspective, because we are at the same level. We are global debts that will never be paid back. During the 30s, it was a period of complete political instability, which we're seeing today. Populist governments, which we're seeing today. Debts that couldn't be paid back, which we're seeing today. So it creates a lot of chaos. So as an advisor, how can we look at chaos and not understand that, hey, some of these things we have to be prepared. We got to be out of the market.
Right.
Right? And because of that, I don't think it's time to be complacent. It's time to take a more cautious attitude, prepare for the storm, and trim back, which is what I started saying in October.
Let's do a comparative analysis. I know you're very bullish on gold. You have been for quite some time. You're also bullish on gold miners. Of course, gold stealing the spotlight at the start of this new year.
Yeah.
With Barrick Gold a couple of months ago, with that merger announcement with Randgold, and now recently Newmont buying Goldcorp. If we can do a comparative analysis, why are you still bullish on gold? And I ask you this in the context of the dismal quarter that we saw, particularly October to December, when folks were running for cover. They didn't make that big play for gold. We didn't see that huge safety play for gold.
Investors aren't, because they're not being advised to. But if you compare the Dow to the HUI to gold since the beginning of October, last time I was here, we have a divergence. The markets, those are starting to return well. The safe havens are working. Smart money is going there. Many days where the bond market was coming off, the dollar was coming off, the market was coming down during December, and gold was up. I posted pictures as we went through on LinkedIn on a regular basis. Now, why the miners? Because they have the leverage, right? The miners are the ones that, as gold moves one time, the miners are going to move up 10 times, because they have the leverage on the earnings. They have reserves on the ground that are going to start to be priced in. There's the chart.
Right.
And it gives us a pretty good idea just with the rebound on that we've had right now, which, by the way, I think it's just a normal rebound after a correction, but we haven't been able to really break 24,000 in any shape or form. So what's more important to me is the fact that one of the things I kept talking about was the USDX, the US dollar. Well, the US dollar's sitting here about 95, 96. Then you have gold at 1,300, ready to break 1,300. So at some point, that divergence is going to break.
Well, look at that line on gold, though. It's not sexy by any stretch of the imagination.
It's not sexy, but there's a reason. You know, Scotiabank paid $800,000 in the fall for spoofing the market. I've been saying all along, and Terry Duffy, the chairman of the COMEX, a year and a half ago said, if you look at what's going on around the world, a guy like that, the chairman of the COMEX, when he says going on around the world, he's talking about systemic risk. If you look at what's going on around the world today, gold should be trading about 5,000 to 6,000, but it isn't.
Right.
And people are dismissing that fact, and they shouldn't dismiss it forever, because one day we're going to see a huge price. My argument has been all along that the same forces that have been pushing the market up have been holding some markets down. And as one comes down, the other one's going to come back up, because we're going to find true value of things.
Okay.
And that's why I'm bullish.
Speaking of true value, I know our viewers want to find some true value here on Market Call tonight. So sharpen your pencil and your analysis. We're going to take a break here on our program. We're with Jaime Carrasco. He's a portfolio manager at Canaccord Genuity. Welcome back to Market Call tonight. We're with Jaime Carrasco. Let's get to your past picks now, and we'll start on a very strong note here. Agnico Eagle doing very well for you.
Agnico, I think, is going to be a company. I sat down with them around Christmas. This company is going to be fully self-sufficient by 2021. So they won't need to raise any money for all the projects going forward. It's one of the few companies that has increased its dividend, has a dividend. And all of that extra cash flow will continue to go into dividend. Another thing that I like about the management is that they have a really good attitude towards the dividend. So I think as their profitability starts to really kick in, it'll be really good for the dividend.
Okay, let's get to AltaGas now. Here, you're under a bit of pressure. You're in negative territory.
I am in negative territory, but again, it's one of those that I'm going to be buying with more cash later. But I did take a position because the price had gotten quite low, so we did buy a little bit in October. But again, it's 25% of what I want to own in the long term, and I think it's a good one to start to have nibbled away. They did cut the dividend, but they've also reorganized everything, and we're pretty comfortable with the guidance going forward. It's one that we like as well. I think it's good, one of the good cash flow payers that I can build on going forward.
All right, speaking of cash flow, you're sitting in a lot of cash, and that seems to have paid off for you, I guess. You're relatively even. You're net even. You're down just slightly. Wow.
Well, 5%. I think I'm going to stay in cash for quite a while. You know, one of the things that people have to understand is systemic risk. In 2008, it was a liquidity crunch. Liquidity means that we ran out of buyers, right? And that's important to understand, that in today's market, 70% of all trading is being done by computers. What happens when they decide to sell? Who's going to be buying, right?
Are you concerned by the algo trading?
Of course I am. That's not a market anymore. A market is you and I deciding on what Bell Canada is. What we have today is algorithms working with money being printed by the Fed that's deciding on where to buy. Okay, warning. You don't have a meeting of governors on Christmas Eve as Mnuchin did. The market doesn't run up 1,000 points on a very liquid market for nothing. Like, these are warnings that people should be looking at, and people in the business should be understanding, hey, this isn't normal, right?
And they're trading on the noise, too.
And they're trading on the noise. It's all noise. To me, we're getting into very dangerous times, and it could come down very quickly.
All right. Well,
so I'm happy to hold cash.
You're happy to hold cash.
Because then I'll be spending my...
When do you see yourself deploying that cash, though? When do you see that working for you? Because I would think that clients at some point are going to say, hey, where's my money working for me here? I don't see clients being too happy with their brokers having them sitting cash for too long a period.
Okay.
Where's the fine line there, Jaime?
That's a good question, because the calls that I've been getting, people are starting to make the disconnecting greed versus getting my money back versus, wait a minute, something's wrong, right? So the questions are starting to pop. Now, it's not the 60% of the people, but 10% of the investors that have been listening to my message are kind of all of a sudden saying, hey, wait a minute, there is volatility. Maybe this is worse going forward. And for some reason, the Fed has never been able to tell us. You know, what was Yellen saying, right before she left? Not in our lifetime are we going to have another recession, right? This whole thing with the Phillips curve. You know, I have knew my work better. Who knows, right? I think everything is in flux.
And then you have Powell coming in with all the mixed messaging.
Right, and then you have Trump. So I don't know. If that doesn't concern people enough to raise some cash, well, I think they're going to suffer because of their greed.
It was a key headwind closing out 2018, but do you see that persisting? I mean, we seem to be getting some positive news on the trade front between China and Huawei, this alleged federal prosecution of Huawei.
That's not good news.
Notwithstanding, that's true. And then you get the noise, if you will, from Brexit. But there was a lot of, we did have a bit of a rally coming into 2019. Is that sustainable? Goldman Sachs earnings coming out not bad?
Well, I don't know. JP Morgan's earnings weren't that great, right? So JP Morgan is the king
Bank of America did okay
of the futures trading. Front. So I would see that as a key concern because they are first of all, JP Morgan has always been the banker for the government. There is a disconnect now with Trump in government and the Fed. There's a bit of a fight going on. That would be of concern to me, right? Again, I tend to analyze things by looking at where the pressure points are. And there's a lot of pressure points. If you start to put a list together, you have the politics, you have the economics, you have currencies. Currencies are in flux. What are the Chinese going to do, right? The Chinese cannot support a massive strike, any kind of social. The real thing, at what point does China pull the plug on the U.S. dollar? It's already being discussed. Look at the currency trades that are happening in Asia. Asia is de-dollarizing very quickly. At what point does the balance switch and it becomes an avalanche? Well, that's inevitable because, again, go back to the 30s. At the core, not of the 30s, why is it so important is because what guys like Ray Dalio are saying, what I've been saying, is the end of the monetary cycle. And that is a very traumatic time, but it's also a period, like the Chinese write the word danger, crisis and opportunity. Why? Because as the power shifts from the pound to the dollar in 1933, the prime beneficiary was the ultimate form of money. And what is the number one rule of power? He who holds the gold holds the power. And we know for a fact that China's sitting right now on 18,000 tons that have transferred from the west to the east because everything was resmelted from pound bars to kilo bars.
Yeah, I read some report where it was Russia and China were really stocking up their gold.
Well, Russia is over 2,000 tons now, right?
Okay, let's leave it there. Fascinating discussion, Jaime. We're going to take a break here on Market Call tonight. Thanks for our viewers' calls. Our number, get them in, 1-855-326-6266. We're bringing you back into the fold next. Time now for Jaime's top picks. Let's start with Metalla Royalty, Jaime.
Metalla is a company that I bought an IPO for myself and just one or two clients because I like the names of the people that were going in there. It's owned by very, very solid people that I followed over the years. They did a money raise just in December. This is another one of the ones that I bought. And there I got in with all of my clients. We fully participated. It came with a warrant, which was a great. This is an early Silver Wheaton. Right, it's an early royalty. They've been adding projects. The cash flow's already kicked in because 3 other projects have already started paying back. They have 29 projects. 3 more kick in this year. They just raised money to buy another cash producer. So what we're going to get out of this is acceleration in cash flow going forward. So the dividend will just build, and that's what I want. Plus, it'll have the capital appreciation. It's well managed. I believe Rick Rule took down a huge chunk of the money raised. So more good money came in. Good, smart people are backing this company, and it's one that I have quite a lot of. I think it's going to do quite well within the portfolio going forward.
All right, and you're quite bullish on India as well via Fairfax, Pramotsa.
2 plays here. One of the things that I've been doing in the income portfolio is I've been trying to make sure that I hedge my currency because the Canadian dollar, if I'm correct and we're tied to the U.S., the Canadian dollar will come down. By the way, gold in Canadian dollars tonight's at 17.80, right, because of the Canadian dollar. When gold was at 1900, the dollar was almost par to the U.S. dollar. So again, I want cash flow from outside to hedge the cash flow. I also wanted to get rid of some of my North American financials. That's why I like this. I'm getting the currency out of India because I think Asia will have the big currency adjustment against the U.S. dollar in the currency reserve shift that I see coming. And India, what I like about this company, Prem Watsa, the Canadian Warren Buffett, it's like buying the financial sector in Canada in the early 60s. Did you know that only 5% of homeowners in India have home insurance? Oh, wow. Massive growth, right? And that's where the income is going to go. So I'm very comfortable holding on to this, as well as other Asian plays that part of that portfolio.
And massive growth in a lot of areas with that burgeoning middle class. And finally, this has been the theme for your hour.
Cash. I continue to recommend that people raise cash, maintain cash, and wait for better buying days. I don't think this market's going to, we've had a massive drop. We're just seeing the first rebound. If it turns, prepare to run, right? Because it's going to go quickly without any liquidity there, right? The Fed has pumped in a lot of money. A lot of the messages that I'm hearing from the Fed doesn't know what they're going to do, right? They're dropping the Phillips curve. All along, I'm be saying, well, that's, you might as well go to a tarot card for, it doesn't really matter, right? All they've been doing is printing money. That's how they've been solving. What are they going to do now? We've gone to almost 240 trillion. We're going to go to 500 trillion next time around, and the next recession's coming. We can't avoid it.
There's a generation of traders that only know QE.
Exactly. Yeah.
It's a scary prospect for them in these times of tightening.
And funny you say that, because one of the reasons why I'm so bullish on gold is because when I started as a bond trader in the late 80s, it was the last generation of bond traders that had worked in a gold standard that taught me the business. So they taught me to think very differently than the guys today, right? To them, it's all these algorithms, and I don't really understand what they're saying half of the time.
Very quickly, do you see more rate hikes on the horizon this year from the Fed?
I don't know about the rate hikes. I think the bigger problem is at what point do they start printing again? Because they're like a monkey with an on-off switch, right? So it's off right now, but it has to go on if everything starts to slow down very quickly.
All right.
And what do we do then?
We'll have to leave it on a question mark.
Follow the yellow brick road.
Okay, follow the gold. All right, sir. Very nice to meet you.
Likewise.
Riveting conversation. Thank you.
Thank you. Thank you for having me.
You bet. As always, folks, consult a qualified financial advisor before making any investment decisions. Thank you so much for your calls tonight. Hope you'll join us tomorrow, 6 p.m. Eastern. Take care.